Cost of goods sold, or COGS. These are the expenses that are inputs into either producing the product you sell, delivering the product you sell, whether that is tangible or intangible. We'll refer to them as COGS. They can then be broken down into variable and fixed costs of goods sold. Variable meaning they move up or down depending on how much or how little you sell. With a variable COG, if I'm selling these Sharpie texters, if I sell 1,000 of them, the cost of the Sharpie times 1,000 is the variable cost of goods sold. To get the Sharpie into my possession, that is another variable cost of goods sold. And then if I need to deliver it to a client, the cost of that is a variable cost of goods sold. So if I sell 1,000 of those, that's my cost. If I then sell 100,000 of these, they're still the same ingredients that go into my variable cost of goods sold. It's just the volume of them goes up. The element that can also work in our favor is clearly if I'm selling 1,000 Sharpies versus 1,000,000 or 100,000 Sharpies, I'm going to get a better price the more I sell from my supplier. If I'm working in construction or manufacturing, it's the input that goes into the end product that I'm creating. Also, what you could have as a variable cost of goods sold might be more like a subcontractor. The subcontractor expense, where you utilize them as and when you need them, could be utilized in that way. Moving to my fixed costs of goods sold, these are the items, as the name suggests, are fixed in nature. But a word I like to use is that they're stepped in nature. Let's go through a couple of examples. Firstly, there's the direct labor. If I'm working in a wholesale business, it might be the people who dispatch the product and work in the factory. If I'm working in a manufacturing business, it's the people who are actually building the product we're selling. And the same thing with construction. If I employ people on a full-time or part-time basis, they form part of my fixed cost of goods sold. If I've got a factory, a warehouse, or even if an accountant's like us, the office that you work out of, where you do your work to create your revenue, that is part of your fixed cost of goods sold. If you're running a manufacturing business and you have an office area and you have a factory area, the factory area is what makes up your direct cost of goods sold. Plus the associated costs of running that factory, such as your electricity, such as your council rates, expenses like that around your property. The other item that can also be included in your direct cost of goods sold might be depreciation. If you've got fixed assets that are being depreciated and being used to create income for your business, that will form part of your fixed cost of goods sold. The reason that I refer to them as stepped expenses is because think about people. You don't go as variable as what you do with the Sharpie pen. You go from 10 people to 11 people to 12 people. They step up. Also with your occupancy costs, you start in one space, you grow too big for that space, you move to a next space. So it's fixed in nature, and also the reason it's fixed is if something happens, you've still got to pay for those expenses. Unlike if I don't sell any Sharpies, I don't have to buy any Sharpies. If I haven't got any work for people to do on that day, I still have to pay the cost of running the factory, employing the people, and the machines are still depreciating. Where you'll see these expenses is in the top section of your profit and loss. You might have already seen the videos around contribution margin and gross profit. Where you should see and how your financials should be set up is you've firstly got your revenue, then you want to have less your variable cost of goods sold to give you your contribution margin. Then from there, you should have your contribution margin is less your fixed cost of goods sold to give you your gross profit figure. Quite often your accountant might just give you your revenue less your cost of goods sold to give you your gross profit. I implore you to push upon your advisors and accountants you work with, whether that's internally or externally, to break down your profit and loss so you see variable and fixed costs of goods sold in their own categories within the profit and loss. That's cost of goods sold, both variable and direct.